Are you heading into 2026 with a stronger retirement plan or the same one you had last year? Every year, the IRS quietly changes the rules. Contribution limits increase, new planning opportunities open, and every year, many investors miss them, leaving tax advantages on the table that can never be recovered. The start of 2026 isn't just another calendar reset. It's a chance to reduce taxes legally, protect your retirement assets, and position your portfolio for long-term tax advantage growth, especially if you understand how to use the rules to your advantage. Hi, I'm Adam Bergman, tax attorney and founder of IRA Financial. For more than 16 years, I've helped investors use the tax code the way it was intended, not to complicate investing, but to empower it. In today's video, I'm going to walk you through 5 essential tax moves for 2026. For many of the strategies we're going to talk about, the self-directed IRA is the most powerful tool you can use. If you're new to self-direction or want a refresher, I've linked a deep dive video in the cards that explain how self-directed IRAs work and the IRS rules you need to follow. Once you understand that foundation, optimizing your retirement plan becomes so much clearer. Now, let's get started. The IRS has increased annual contribution limits for IRAs and 401ks in 2026. This is based off inflation and a higher cost of living. So if you look at 2025, the IRA contribution limits were $7,000 or $8,000 if you were over 50. In 2026, that's now $7,500 or $8,500 if you're over 50. The good news is in 2026, you can still make 2025 IRA contributions up until April 15, 2026. Like IRAs, in 2026, 401k contributions are also going up. Employee deferrals in 2025, $23,500 plus a $7,500 catch-up if over 50. Those new numbers for 2026 are $24,500 and an $8,000 catch-up if you're over 50. When you add everything together, employee deferrals and profit sharings, and this is especially important in a solo 401k plan, in 2025, those contributions combined were $70,000 if you're under 50 and $77,500 if you're over 50. 2026, the new numbers are $72,000 if you're under 50, $80,000 if you're over 50. Overall, IRAs, 401ks, you can now put away more money in 2026 than you can in 2025, which is a great thing. The second most important tax strategy for 2026, Roth conversions. What a Roth conversion is you take an asset in a pre-tax IRA that would be subject to taxation when you pull it out after the age of 59 and a half, and you convert it and shelter the future gains to a Roth. When you convert a pre-tax asset to Roth, you do have to pay income tax on the value of what you convert. But here's the catch. Once the asset is moved from pre-tax to Roth, so long as you're over 59 and a half and the Roth's been open at least 5 years, the asset is fully sheltered from taxation. Here's an example. You convert a piece of land that's worth $50,000 in 2026 from pre-tax to Roth. You pay income tax on the $50,000, which is added to any other income you have for that year, which then based off your tax rate determines how much tax you pay. Now that that asset is in a Roth, once you're over 59 and a half and the Roth's been open at least 5 years, if that piece of land goes to $1 million or $500,000 or $1 billion, you can pull it out tax-free. You don't have to pay $1 in taxation. So you've basically eliminated any future tax. Now, of course, the risk is if the asset drops in value, you've now paid tax to Uncle Sam at a higher value. And that's the lesson of Silicon Valley Bank, Lehman Brothers, or Enron. So obviously you want to be cautious. You want to do your research, understand, number one, can you pay the tax on the conversion? Are you optimistic and have a very strong belief that the asset will go up in value? What will your tax rate be when you retire? If you think you'll be retired and have a very low tax rate, maybe a conversion doesn't make a lot of sense, because even if you pull the asset out from your pre-tax IRA, you'll have minimal tax burden. But maybe you're going to be working your whole life like me, and you plan to have a high tax bracket. Then doing a Roth conversion makes more sense. And obviously you need to be able to pay the tax today. So those are the kinds of things that matter when considering a Roth conversion. The third most important tax move that can strengthen your 2026 is free cash. If you have access to a 401k plan at work, whether it's a 401k, a 403b, a 457b, and there is an employer match, which generally is 3 to 5% of your compensation. Okay, like IRA Financial, we do a 4% match. So if you make $70,000, 4%, that's $2,800 of free money. Now, generally, in order to get that 4%, you have to put in 4%. Okay, that's called a qualified match. Now, a non-qualified match, what IRA Financial does is you get the 4% no matter if you put in $1 or 4%. Most companies aren't as nice as IRA Financial. So you want to make sure to understand what your employer is doing. What's the match? Is it 3%, 4%, 5%? How much do I need to put in from my 401k as an employee deferral to get that match? Because you want to do that because that is literally free money. So if you put in 4%, that's $2,800 over the year, your employer will automatically give you $2,800 of free money. Okay, so you don't want to miss that. A lot of folks miss that opportunity because they're just not aware of this important factor. But I'm telling you, 2026, ask HR, ask your employer, hey, how does the match work? What do I need to put into the 401k to get a match? And then obviously then tabulate based off that discussion how much you want to contribute through payroll so you can get your free money. The fourth move to strengthen your retirement planning in 2026 is ROBS. So if you are looking to fund a business, maybe start a business in 2026, you're an entrepreneur, veins are cooking, and you feel like, hey, this is the year I want to start a business. I want to do something of my own. I bet you didn't know that you can use your pre-tax retirement funds to fund a business tax-free. That means you don't have to take a taxable distribution from your IRA or former employer 401k plan to use those funds to start a business. There's something called a rollover business startup solution. I actually wrote a book on it, how legally under 4975 D13 of the tax code, which is an exception to the prohibited transaction rules under 4975C, you can use a C corporation, okay, that creates a 401k plan. And don't worry, we do it all for you. You then roll over your IRA or 401k funds tax-free into this new 401k plan. And then the 401k buys stock in the corporation, which then moves the money from your IRA or former employer 401k to your new 401k, which then moves the money to the corporation, which you now have to buy your new business or fund your business. The stock of the corporation goes to the 401k. So now the 401k owns stock in the company. So if you sell the company and it's a stock sale, you don't pay tax on the sale of stock because the 401k owns a chunk of the stock. Plus, any net income, any retained earnings after the corporation pays 21% tax will go back to the 401k shareholders tax-free. So what does the ROBS do? It allows you the chance to use your pre-tax IRA or former employer 401k funds tax-free, penalty-free, use it to invest in yourself, to start a business, fund your business for 2026. It's the only legal way to do this without triggering tax. A self-directed IRA won't work if you control more than 50% of the business because that would trigger the prohibited transaction rules. But because ROBS takes advantage of an exception under 4975 D13 of the tax code, you can do this structure and have the 401k buy stock in the company, transfer the money from the 401k to the company in return for stock. Company now is the cash to go buy assets, hire employees, pay rent, do the things a business needs to do to make money. And then all the money that the company makes, you can send it tax-free back to the 401k after paying the corporate 21% tax. Or if you sell your business and it's a stock sale, it's all tax-free. So ROBS is a great solution. If you're thinking about starting a business in 2026 and you have some retirement money, maybe a great way to use those funds tax-free, penalty-free, and invest in yourself. The next major move to strengthen your retirement planning in 2026 is something you should be doing every year. It's basically your annual retirement compliance checkup. That's what I call it. And that's something I'm really proud about with IRA Financial because we're one of the only self-directed retirement firms that have a full compliance tax firm. So we have attorneys, CPAs on staff that will help you navigate IRS rules and give you your self-directed retirement checkup. What does that mean? It means we go through your investments. Hey, Are there any prohibited transaction issues you should be thinking about? What about this thing called UBIT, unrelated business income tax? Do you get any K1s? We'll help you look at your K1s to see, hey, is there any potential tax items here that I need to consider? What about your beneficiary form? That's something that people forget about. Every year, you should be looking at all your IRA and 401k beneficiary forms, especially if you had a change in your life, right? God forbid there was a death in your family, or maybe a divorce or a separation. You want to make sure your beneficiary form is updated. Your primary and your contingent beneficiaries are exactly how you want them to be. Why? Because these beneficiary forms trump your will. Yeah, I know. A lot of people don't realize that. Even if your will says, hey, all my money is going to go to X, but your beneficiary form says Y, the beneficiary form based off case law will trump your will, because you don't want your retirement money going to the wrong person. And trust me, over the last 16 years, I've been in multiple situations with clients in depositions because unfortunately they've left the money to the wrong person. It wasn't intended. We had a beneficiary form said person Y, but the will said person X, and the beneficiary form trumped the will. So be cautious about that. But the good news is this: if you're a client of IRA Financial, this is what we do. You just need to pick up the phone, call us, chat us, email us, and say, hey, I need 5, 10 minutes, 20 minutes, 30 minutes with someone. I want to go through my investments. I want to go through my structures. I want to make sure there's no prohibited transactions, no UBIT, no hidden tax pitfalls. I want to make sure my beneficiary forms are updated. I want to understand all the new updated 2026 IRS rules. Guess what? We do that for you. We don't tell you, no, go hire an accountant, go hire a lawyer. No, we do that for you. And that's what really sets us apart. Thanks for watching. If you enjoyed this video, be sure to like and subscribe to the channel. We publish new videos every week on self-directed investing.